Great. Well, good afternoon, everyone, and thank you for joining us today for our Economic Outlook hosted by Ken Frost, Chief Investment Officer at WFA. Ken has prepared some great content for us, and we're excited to dive in. As a quick note, we wanted to mention that all lines will be muted for the duration of our call, and we ask that you please direct any questions to your financial advisor. With that, I'll turn it over to you, Ken.
Thank you very much, Brooke. So many of you I know have attended my semi-annual meetings in our office here. I don't know who's on the call today. I suspect many of you have been in here before, so you've seen past presentations. I want to just point out that this presentation is going to be kind of a condensed version of that. It'd probably be 40 to 50 minutes. I have a lot fewer slides. I have a lot less detail in the slides, but some of them are a little bit detailed. So without the benefit of the big TV and my little pointing stick, I have to kind of explain some of them to you. But I hope that it's concise enough and understandable enough that everybody comes away with some understanding of how we see the world anyway currently. So with that being said, let's get started. So what I'm really going to do is I'm going to review the economic situation that we're in today as best that we know. And I'm going to talk about some possible economic recovery scenarios. We have to all understand that the situation is very, very fluid. The numbers change almost daily. The estimates change almost daily. So these have to be viewed in terms of scenarios and probabilities. It's very important to think about the concept of what's possible versus what's probable and try and keep that in the back of your mind. I'm going to look at a review of the bond market because there was some interesting things going on in the bond market, and I just want to talk about that a little bit. Stock market, of course, we're going to talk about, but again, not in the detail that I do kind of in the in-person meetings, but hopefully it will shed some light again on kind of where we think the world is going. And then talk specifically about some of the portfolio strategies that we've been implementing and that we intend to implement going forward. I'm not going to talk about any specific details. I'm not going to mention any specific stocks or any specific bonds, for example, but just kind of in general what we're trying to achieve. So just kind of taking a step back and taking an overview of what an economic cycle looks like, I thought would be interesting. So this is a picture basically of a picture you would see in a textbook, an economic textbook, talking about the way an economic cycle typically plays out. And what I wanted to point out here is that a recession, which I think is almost certainly what we are in currently, and I'll talk about that more in a little bit, but a recession is not the time frame from the peak of economic activity to the next peak. It's from the peak to the trough. And I think a lot of people overlook that because I've had many people talk to me about, it's going to take us years before we get back to where we were. Well, that may be, but the recession isn't going to be years. The recession may be quite short, or it could be elongated, kind of depending on some of the factors that we'll talk about. So what happens is the economy peaks. It then goes into a recessionary period where it troughs and then goes to an expansion. Now, in more recent years, economists have tended to define that expansion in terms of two periods. That is a recovery period where you get back to where you were at the previous peak, and then an expansionary period where you exceed where you were in the previous peak. So, and that cycle plays out. Why is there an economic cycle? Well, I'm not sure anybody's ever been able to completely define that perfectly, but essentially what happens is imbalances develop, and they have to be corrected during the recession. And then once those corrections are made, everything starts over again. What is a recession? How is it defined? Well, the National Bureau of Economic Research defines recessions. They do so by looking at various measures of economic activity and just kind of determining when that peak is and dating that in retrospect. They may not tell us when the recession started for another 6 months or even a year. They have to wait till all the data gets in and then they'll define. It's more of an academic process. It's not a predictive process. Now, economic data is conveyed in terms of gross domestic product, or more specifically, real gross domestic product, which is after you subtract inflation from the growth rate of the economy. GDP is calculated on a quarterly basis. We just got the first quarter's estimate this morning, and we'll talk about that in a second. But the National Bureau of Economic Research actually dates recessions to the month. So they do not date it in terms of 2 quarters of negative GDP growth. They'll date it at the end of a particular month that may be in the middle of the quarter. My personal view is that they will probably end up dating this recession as the beginning on March 1st, possibly on April 1st, but they'll look at the data and determine that. Next slide. So this is a couple of slides, or a couple of pictures that kind of convey in real time, or in real historical view of what recessions look like. On the left side, you see the shaded gray areas are National Bureau of Economic Research defined recessions going back to the end of World War II. And the blue line is the actual real growth of the economy in the US. And you can see where it peaks, kind of rolls over, troughs at the end of the recession, and then heads back up. So there's a couple of things to look at here. The economy grows most of the time. Recessions tend to be relatively short. Most of them are relatively mild in the sense that the line doesn't really turn down all that much. Now, the last one, the great financial crisis, that was clearly a very deep recession, as you see by that line. Now, on the right-hand side, I'm looking at the same data in a little bit different way. This is looking at the year-over-year growth rate of the economy. And you can see, again, the shaded areas depicting recessions. So what I was trying to point out here is that you can clearly see that the annual growth rate in the economy tends to kind of expand coming out of the recession and then kind of slow down. You see it kind of go from maybe growing 7% per year down to 5% per year, and it kind of slowly falls into a recessionary mode, for lack of a better word. The other thing that's interesting is that in some recessions, the one after the tech bubble, for example, the year-over-year growth rate actually never really turned negative. You see some of these were really quite shallow back in the early 60s. The 1970 recession was quite shallow in the sense that year-over-year economic growth was quite mild. Now, the next chart is a little bit more complicated, but it conveys something that I think is very important about this cycle. So this is looking at data that the Federal Reserve Bank of Philadelphia puts out, and is essentially, there's a calculation involved, but essentially what it's measuring is how many states are expanding at any given time versus how many state economies are contracting. And you see that in the second panel down, which is the 1-month diffusion index. And you see, again, the shaded areas are recessions, and you see how as you come up out of the recession, more and more states' economies expand until you plateau, and then they start to show some weakness, and fewer states are expanding as you get into the recession. Now, notice on the right side of that chart there, that 1-month diffusion index basically fell off a cliff. The self-induced nature of this cycle, that is, we didn't really follow a business cycle. We didn't get to the point where there was an imbalance in the tech sector, for example, like during the tech bubble, or there wasn't some sort of an imbalance in the housing sector like there was prior to the great financial crisis. This is really a self-induced recession brought on by the quarantine and the closing of various sectors of the economy as people were staying home. So you can see that both in the 1 month, as I just talked about, and then the 3 month and the 6 month indexes, which are down below that. These tend to be a little bit less volatile, but you see the same effect. Typically, the business cycle plays out, you see the slowing, and then you fall into a recession. We didn't get any warning this time. It happened in a month's time, basically. Because of that, it really wasn't picked up by any of the leading indicators that usually are pretty reliable in forecasting recessions. The February leading economic index from the Conference Board actually expanded. It wasn't until on the 17th of April that we got the index for March that we saw any indication of a decline. So it was really, didn't lead at all. It functioned more as a coincident index. The next slide here is looking at economic recessions historically, going back to the Great Depression. So I wanted to highlight several things on this. Number one is you can kind of look at recessions in terms of their depth, that is how destructive they were to the economy, so to speak, their duration, how long they last, and the diffusion. And we just talked about diffusion essentially in terms of how many states participate. If you study that state graph a little bit, you'll notice that sometimes you might have 40 states that are still expanding even in a recession, or sometimes you'll have 10 or 15 states that are still expanding. You could also define diffusion in the sense of how many industries are participating. As I mentioned, the last two recessions were kind of focused on the tech area and then in the housing and finance area. One might surmise that this recession is really kind of focused on what you might say the tourist areas or the recreational areas, in the sense that it's restaurants and it's travel and it's retail spending, for example. So the question is, how diffuse will that be across various industries? And we don't know yet. I mean, clearly the people that are laid off in the retail industry aren't feeling confident enough to go out and spend on travel and so forth. So it's a question of how it spreads from those industries and how long we have to maintain these various lockdown orders. So back to the history. So you can see on this chart, the circle represents how deep the recession was. And on the left axis, the vertical axis, you can see how long it was. Now, the Great Depression obviously was the granddaddy of all, with total GDP decline of 26.7%. That is, the economy shrunk by that much after adjusting for inflation and lasted almost 4 years. The other deep one was in the 40s. You had a 12.7% decline. It lasted a few years. And then the other deepest one was the one we went through 10 years ago, the financial crisis, where we had a total contraction of the economy of about 4%, lasting a couple of years. So the point is, when you look at these recessions, there's some quirks here. Now, number one, in the post-World War II period, we really started to standardize the way that these things get measured. If you look at the history of the Depression, for example, what you'll find is that measurements of the economy weren't the same as they are today. Measurements of unemployment were not the same. You'll find estimates of what the unemployment rate was because they didn't really calculate it in the same way that they do today. You can take issue with the way the unemployment rate is calculated today, but at least it's been calculated on a consistent basis for decades. So for example, in the Great Depression, it's estimated that unemployment got to 25%. But they don't really know for sure because it wasn't, again, measured in the same way. Two of the recessions, as we talked about, including the Depression, saw double-digit declines, and 3 saw a decline of at least 4%. The average length of recessions, beginning again with the Great Depression, was about 13 months. And the Great Depression lasted 43 months, and the shortest was only 6 months. Now, current estimates of where we are today, there are those who believe this recession will be very short, but very deep, and see a substantial rebound. Others think it's going to be very deep, but last longer. And again, we're going to talk about some of those scenarios going forward. Unemployment is a very important indicator in any economic environment. And again, because of the nature of this particular economic scenario that we're in with the forced shutdown, the economic numbers are frankly terrible. You can see on the left side there that the number of people filing for unemployment benefits has been 26.5 million people just in the last 5 weeks. And on the chart there, it's literally, off the charts compared to historical data. It's interesting to note that we created about 22.4 million jobs during the 10 plus years of the last expansion. So essentially we've knocked out all of those jobs that we had created, plus a few more. Now it is thought generally, even by the more pessimistic analysts, that a lot of these job losses are temporary, and I certainly hope that that's the case. The right one shows the unemployment rate. Now, the unemployment rate is a little bit confusing because it's determined by looking at a couple of different data sources. So you're looking at actual people who file for unemployment, but you're looking at what's called the labor force, and the labor force varies. So it's somewhat difficult to make estimates going forward because you don't know exactly what the size of the labor force is. Why is that? Well, because you're not in the labor force, according to the calculations, if you're not actually looking for a job. So if you become unemployed and you give up looking for a job, you're no longer in the labor force. Conversely, if you retire, you're obviously no longer in the labor force. And there are a lot of people retiring across the country every day. So the estimates of unemployment going forward are quite varied, simply because we don't know exactly what the size of the labor force is going forward. Now, each month when the numbers come out, you have a better idea. So the point of that is you see the huge jump in unemployment claims on the left, but you see the unemployment rate is only at 4.4% for April. That's partly because everybody wasn't into the data yet. So the unemployment rate for May is probably going to be quite terrible. So the estimates I've seen range from 14 to 25%. I've also seen estimates for the second quarter where the range is going to be from 15 to 20%. So again, in the Great Depression, it got up to an estimate of about 25%. So we're talking about numbers that are starting to border on that kind of a situation. Again, probably temporary as we start to open things back up, but the numbers for May and June and July probably are going to look pretty bad. So this morning we got the estimate for the first quarter's GDP. Now, it's very important to remember that GDP is given in terms of what they call a seasonally adjusted annual rate. What that means is they're giving you the rate that would apply if that quarter's growth rate happened for 4 quarters. So the number that came out this morning was a negative 4.8% annual rate, which sounds bad because that's obviously bigger than the 4% that we saw in the Great Financial Crisis, and this was only for a quarter. But remember, that's an annualized rate. The actual decline for the quarter was 1.2%. And in fact, the the quarter over quarter from a year ago, that is the first quarter of 19 until today, was actually positive by a very small amount, 0.3%. So the economy actually grew from the first quarter a year ago to the first quarter of this year, but it shrunk from the fourth quarter of 2019 to the first quarter of this year at a 4.8% rate, which was actually literally 1.2%. Now, on the screen here, we have current estimates as of the 13th of April for what the second quarter will look like from a variety of analysts here. And you can see they range from a -9% up to a -50%. And again, remember, that's an annualized rate. So for example, a 25% decline in the second quarter on an annualized rate would be a 6.9% literal quarter decline. But if that were to be the case, then we'd be looking at a recession in the first two quarters of this year that would exceed the last recession of the great financial crisis. So this picture, you're going to be asking yourself, why am I looking at this picture? Now, I took this picture in 2011 on vacation. So you didn't know when you signed up for this that you're going to be looking at my vacation pictures, but I figured you needed something to do while you're stuck in your house. But what I really am trying to convey here is a couple of things. So I took this picture in Ephesus, which is in Asia Minor, in what is now Turkey. And this is a statue of the Greek goddess Nike. The Greeks pronounce it Nike. And this is a way for me to show you the Nike swoosh without actually using the copyrighted Nike swoosh, which I've highlighted in that little red box there. The tourist people there will tell you that that's the inspiration for the Nike swoosh. And the reason I put that in here is because there's a lot of debate on what the shape of the recovery will look like, or what the shape of the recession and the recovery will look like. And I don't really buy the V shape, and I certainly hope it's not going to be an L shape where we have a steep decline but a very elongated recovery. The V shape would say we're down for one quarter or so, and then we have a very steep recovery. I think it's going to be obviously it's going to be a very steep decline, as in the Nike swoosh there. It's probably going to turn up maybe a little faster than that picture, but it will be elongated as people become more comfortable with coming back out and spending money, basically. So what are going to be the factors to help with this recovery? I think it really comes down to consumer confidence. And this is really a psychological aspect. People have to be comfortable with going to restaurants, and they have to be comfortable again with going on airplanes, and they have to be comfortable with going to the shopping mall. And so what is going to increase that confidence? Well, I think there's several things. You probably have seen or read some of the more recent studies coming out about the antibody studies and so forth, trying to identify how many people have been affected. From day one, most of the experts had mentioned that, we have confirmed cases of coronavirus, but we suspect that a lot more people have it than have been confirmed. So some of these serology studies, they're called, have attempted to sample various people and do the antibody test to determine whether they show the antibodies in their system to imply that they've actually had it, but were asymptomatic, or maybe they had very mild symptoms. And the numbers that have been coming back are pretty interesting. They did a study in Santa Clara County. It was done by Stanford Medical. They've done one in LA County that was done by USC and Stanford in conjunction. There's been one done in New York. There's been one done in a city in Italy. There's been one done in a city in Germany. There's been one done in Denmark, and there's been one done in Iceland. The numbers come back are quite varied, but they imply that For example, in Santa Clara County, they suspect that that the actual rate of infection was 50 to 85 times higher than what they actually knew from confirmed cases. In Italy, for example, it's around 30 times higher. In Iceland, it's around 10 times higher. So my point here is just that the more data that comes out, we may start to feel more comfortable that there's actually been a higher rate of infection, which means that the true mortality rate is much lower than we know today from the data. So that could increase consumer confidence. Clearly, if there's widespread reliable testing, that will increase consumer confidence in their willingness to go out. Development of effective treatments, of course, would be very important. If you get it, is there a reliable way to treat it? Development of the vaccine would be the most important one. And not just the development of the vaccine, but a widespread availability of the vaccine. Now, the stock market was up quite a bit today. I think the rationale would be because the second quarter GDP, even though it was bad, was not as bad as the worst case estimates. As I mentioned, it came in at 4.8. The range was actually -6 to a -0.3. So -4.8 was kind of in the middle, but it wasn't the worst. The other factor, I think, was the story coming out of Oxford, England, where they have a vaccine that's actually quite a ways along in development that they claim could be out by September. You know, we'll have to see if that's actually true, but I think these kinds of things help with the consumer confidence, which would help to boost the economy coming out of this. So let's get into some of these scenarios. Now, I will tell you that I borrowed liberally from a Deloitte report entitled Recovering from COVID-19 in the development of 3 scenarios here. I also borrowed from a McKinsey report, from a Bloomberg economics report, and then we did our own little data manipulation here in the office. So the milder report, or the milder scenario, looks at what would the 2020 GDP look like under the milder conditions. And under these conditions, the United States economy would shrink by about 5% during the year. Remember, in the financial crisis, the total contraction was about 4%. European Union about the same. China would grow at 3%. Recall that China typically grows at about 6% per year. It's always a little questionable whether the data is correct, because they always seem to grow at 6% per year. And prior to that, they were growing in double digits. So 3% is a very low rate for them. Japan would be at 0%. What would this look like? A deep, relatively short global recession with the virus dissipating through the warmer summer months in the northern hemisphere. We get testing and tracking that could be used to deal with any future waves so that we didn't have to shut down the economy again. Recovery in the global economy would begin sometime in the second half of 2020. We're thinking here the third quarter or the fourth quarter. And the significant fiscal programs that we're seeing would be effective in limiting the damage to individual companies and to the citizens. Under the harsher economic scenario, which is really the middle one that we're going to look at, 2020 GDP declines by 8% in the US and the European Union, and grows by 1% in China and shrinks by 3% in Japan. This is a much deeper recession. There's recurring waves of infection. We don't effectively have a way to treat it, and recovery doesn't begin until the second half of 2021. As a result of that, you get severe disruptions in supply chains. Consumer demand is disrupted. We don't get to go back out shopping to the malls and so forth. And fiscal problems are somewhat effective in limiting the business failures, but they fail to significantly boost consumer spending. And then in the more severe economic scenario, we're looking at a GDP decline of about 10% in the US, 10% in the European Union, and a decline of 3% in China and 6% in Japan. In this one, we get multiple waves of infection that go all the way into 2021, and it isn't halted effectively until we either have an effective vaccine or is halted by herd immunity. I'm sure you've probably read about the concept of herd immunity. Basically, it suggests that once enough of the population has contracted the virus, that it can stop spreading. Nobody knows what the rate of herd immunity is for the coronavirus. For example, measles, you have to have about north of 95% herd immunity in order to stop it. This one, they've estimated it needs to be about 50 to 60%, but again, these are estimates that they really don't know for sure. We also don't know that if once you've had it, how long that immunity lasts. These are things that we still have to learn. Recovery begins mid-2022. There's significant business failures, significant personal bankruptcies, for example, and the healthcare system is severely disrupted. So this is clearly a severe economic scenario. The WFA Investment Committee took it upon ourselves to kind of do a probability assessment of what we thought of those three scenarios, and again with input from other sources. So our assessment on the right-hand side there, we're giving a 40% probability to the milder scenario, a 44% probability to the harsh scenario, and a 16% probability to the severe scenario, which implies that recovery begins in late 2020, early 2021. In case you're wondering, of the 4 members of the committee, 2 of us chose the milder scenario as the most likely scenario. 2 of us chose the harsh scenario as the most likely, and nobody chose the severe scenario as the most likely. I mean, you can apply your own process to that and your own information to that to compare, but I think that's a reasonable assessment. Somewhere between the best scenario and the mid scenario, it seems like a very likely situation. It really depends on what's going to happen here in the next few months in terms of opening back up and how many people feel confident going out and shopping and traveling and so on. So let's get off the economy for a while. That's getting a little bit dry, and let's talk a little bit about the financial markets. So again, I wanted to emphasize that because of the nature of this, and because I don't have you in the office, feeding you lunch and under our control, that I'm trying to make this as concise as I can, but I don't have my little pointer to point at things, and I make sure that we get the point across without going into quite as much detail as I normally do. So the bond market looks like this as of Friday. You have 2-year treasury yields, you can get 0.2%. If you had a money market account, you're getting basically 0.5%. If you're in cash, you're getting 0.1. A 10-year treasury, if you buy that today, you're going to get about 0.6%. That's very few people are going to be able to live off their portfolios earning 0.6%. The U.S. aggregate index, which is an index of investment grade debt in the United States, treasuries, agencies, and corporate debt, yielding 1.39%. You can go out and take a little bit more risk and get yourself a 5-year A-rated corporate bond and earn 1.3%. Again, these are not rates that are going to excite anyone. The high yield market provides better yields. Remember, high yield is a euphemism for junk bonds. These are below investment grade rated bonds. You can earn significantly more in that market at 8.4%. and emerging markets, you can get about 6.6. These are based off of Barclays, Bloomberg Barclays indices out of the Wall Street Journal. On the right-hand side, I just wanted to put an illustration here to clearly identify the history of, in this case, the 10-year Treasury bond. Your expected return when you buy a bond is basically what the yield to maturity is on that bond. So just to illustrate that so there's no confusion, you buy a 30-year Treasury today at 1.18%, you're probably going to earn 1.18% no matter what the holding period is that you have. Now, there are exceptions to that. If we find ourselves in the United States in a situation like Europe, for example, where you have many government bonds trading at 0 or less, if the 30-year Treasury were to go down to 0, you would see a significant increase in the dollar value of those bonds. We have to ask ourselves what the likelihood of that situation is. Here, we don't think it's particularly likely, but it is possible. Again, what's the difference between possible and probable? But it is possible that you will see a 10-year or a 30-year Treasury get down, to 0.5% or lower if we got into the severe economic scenario. This is a chart of the stock market in various severe climates. So this is a chart that's talking about what's termed waterfall declines. And this is a term that's used by Ned Davis Research, which is a research firm that we get research from. If you're wondering what a waterfall decline looks like, just look at the chart there on the left. The light blue line is showing the 1929 stock market crash. The beige line is showing us the 1987 crash, and the dark blue line is showing us our environment as we lived through it from February 19th through March 23rd. So you can see what we're trying to convey here are several different things. So number one, this decline has been the fastest in history to reach 20% decline. 20% is the common definition of a bear market. There are analysts who would use a little bit more nuanced definition than that, but it's very common to say if you hit a 20% decline, you're in a bear market. So it only took us 16 trading days to do that. From the total waterfall decline from the 29th of February through the 23rd of March, we fell 34% in 23 trading days. That is also was the fastest to ever get to a 30% decline in history. So you've got 2 world records under your belt. Now, people oftentimes have mentioned to me in the past about the 1987 stock market crash where we saw a 20% decline in one day. Now that's true. However, the market, as you can see on this chart, was actually declining for some time before we hit that day. So even though we did see a 20% decline in one day in 1987, when you take in the total duration from the peak in 97 to that decline and compare it to the peak today, we actually did that faster this time around. Now, the right-hand chart is a little bit complicated, and I'm not going to point out all the details in here. What I really just want to summarize it by saying that in the past, and these are listing a series of 13, quote, waterfall declines, that in the past, whenever we've had one of these, in 9 of those instances, we ended up eventually going to a low that was lower than that waterfall decline low. That is, you get the big decline, you get some sort of a rally, and then you go back down below that bottom that you reached. Now, so 9 out of 13 times that happened, which is 69%. The other 4 times, there was some sort of a retest that didn't go below the previous low. that's 92% of the time you get a retest. So on the chart here, you can see in these the little yellow boxes that are highlighted, and this is using the Dow Jones as its reference, that in those 9 cases where you went below that initial low, it went below by an average of 7.2% and a median of 2.4. The point I'm trying to make here is we've seen a very nice rally off of that March 23rd bottom. History suggests and probability suggests that we'll see some sort of a retest. We cannot guarantee that we will or we won't. History says we will. I think we have to respect that. But we aren't, and I'll talk about this later in the portfolio section, we really aren't in a total bearish mode as far as portfolios go, because we do believe that we are, valuations have gotten better and that the market will start to do better going forward. We're just not sure that we won't see some sort of a retest of those. Let's switch back to the bond market for a second. I mentioned on the conference call that we had in March, I don't know how many of you might have been on that, but I mentioned the severe disruption in the bond market in March, which seems counterintuitive, because normally what happens is if you have stock market volatility, you're going to sell stocks and rush to bonds. And that typically happens for treasuries. You do see a rush to quality in treasuries. Corporates typically don't sell off all that badly, but in this instance they did. And on the left-hand side, what we're looking at is a measure of AAA corporate bond yields compared to 10-year treasury yields. This is an index put out by Moody's measuring corporate bond yields. You can see that prior to, on the right-hand side of that left chart, you can see that the yield spread, as it's called, between the corporate debt and the treasury debt was running at about 1.25 percentage points and then shot up almost overnight to over 3 percentage points. This is a measure of extreme stress in the system. What was causing it was a combination of things. Funding problems in the overnight lending rates that the Federal Reserve has tried to deal with through various measures and seems to have dealt with effectively. It also has to do with investors being caught with the stock market going down so dramatically that those who had borrowed money to invest in the stock market needed to cover those margin calls, as they're called, and had to sell virtually any asset in order to raise cash. So they sold things that could be sold. So they sold bonds, they sold, even gold got hit a little bit in that environment where you would think that gold would do quite well. So we had an environment for about a week or 10 days that was extremely unusual, where bond yields went very high, spreads went very high, and then quickly corrected, as you see on that chart there. Another thing that was and that has an effect on really the reports that everybody received for the first quarter, because at the end of March, when we sent out our first quarter reports, not only was the stock market down, but the bond market was down too, and it just happened to be down right at the month. In April so far, bonds have come very nicely, and along with stocks, and I think you would be pleased to see the performance of those portfolios for the April period. Another thing that exacerbated that, at least I think that exacerbated that situation in March, was a situation that developed because of the financial crisis. So regulatory changes after the financial crisis limited banks' ability to hold bonds in inventory. And so what happens is, you can see on that right chart, the left-hand side of that right chart, you can see that the primary dealer inventories as a percent of total U.S. corporate debt went from about 4% all the way down to essentially 0. So the bond market is funny compared to the stock market. On the stock market, you know, things trade on an exchange. You can get a quote any minute of the day on what IBM is selling at. But you can't necessarily get a quote on what IBM bonds are selling at any moment of the day, because this is a dealer market where dealers have bonds in inventory. If I want to buy a bond, I go to the dealers and I see if there's anything there. We do a bid and ask process. It's not as liquid. So the fact that you had less players in that market, I think, contributed to the situation in March. So let's go back and talk about the stock market and kind of where we are and what that might mean going forward. So this is a chart on the left-hand side. It's basically showing us the returns needed to get back to the market peak. Now this is a little bit confusing, and I want to just kind of explain it so that when you look at it later, you'll understand what we're talking about. So, and I will also point out that the market has moved around so much since I put this chart in here that the numbers today are different from what they are on this chart. In fact, they're better today than these numbers are. These numbers are from April 21st. So, look at the left-hand side, look at that horizontal bar that says 1 year and 26%. What this is saying is from the 21st of April, you would need to have a 26% gain, including dividends in the S&P 500 to get back up to the level of wealth that you had on the market's peak on February 19th. So on all of these cases, they are assuming a 2% dividend on the stock index. So that's why you see at the two-year number, you see that it says 28%. That's because a year with another year tacked on, you're going to get another 2% dividend yield on the index. So you would need to make it an extra 2% to get there over 2 years. The bar itself is the compounded annual growth rate required. So if you look at the 2-year number, you're going to need to make 28% cumulative. And you're going to need to make 13% per year to get back to where the level of wealth that you had on February 23rd. At the 3-year level, you're going to need 31% cumulative, which is 9% compounded. Now, these are rounded numbers, and there's a compounding in there, so they don't always, 28 to 31 is obviously 3 percentage points, but there's some rounding and compounding in there. So the point here is that historically, the stock market, since 1926, when we kind of have the best data, has tended to grow at about 10% per year, including dividends. So to get back to the previous high over a 3-year period would be roughly a normal kind of environment. Now, if we see a stronger snapback than that, we could get back within 2 years or even 1 year. We're already 30% off of the bottom as we speak today. So could we advance another 26% over the next year? That's not out of the question. But again, we have to ask ourselves what's probable versus what's possible. So if we look at this, the point is, yes, we had a big sell-off. Yes, we've already bounced back a lot, but it's not a heroic thing to get back to where we were over a 2 or 3 year time period. On the right-hand side, I wanted to talk about the way certain asset classes behave both during a drawdown or during a recession and during a recovery. So, but first I want to highlight. So since World War II, the average price decline during a recession is actually 0%. Now that intuitively doesn't make any sense, but that's because the stock market tends to peak prior to a recession, and it tends to bottom about 3 months before the recession ends. So that if you look at it if you look at the data on a chart, you'll see that from the time you enter the recession, the stock market's already gone down. And by the time you exit a recession, it's already gone up, so that you're almost exactly where you were when you began. On average, the stock market's bottomed about 3 months prior to the end. Since World War II, when you look at the peak to trough decline in the stock market, not the economy, but the stock market, knowing that it tends to peak prior to the economy peaking and tends to bottom prior to the economy bottoming, has been about 30%. Now, if you look at that chart, you'll see that the S&P 500 in the last 4 bear markets has averaged a 38% decline. And frankly, the last 2 bear markets that we've been in, those associated with the tech bubble and those associated with the financial crisis, were bigger than that. The tech bubble declined by 49%, and the financial crisis was about 55% or something like that. So those were anomalies in the sense that they were very large and kind of make that average bigger than it would be otherwise. So on this chart on the left, the right-hand part of it, we're looking at what happens to various asset classes on the 12-month prior to a bear market, during that drawdown, and then in the 12 months of recovery. And this is looking at the average of the previous 4 stock bear markets. So kind of going forward, I just wanted to focus on the drawdown and the 12 months recovery. So we're looking at 9 asset classes here: US stocks, international stocks, emerging market stocks, treasury bonds, corporate bonds, both high yield and investment grade, looking at the dollar for currencies, looking at gold, and looking at cash. So those gray bars are the stock indices, and you can see that they typically decline by around 40%. Now we know that from peak to the bottom so far in this bear market, we're already down 33%. So we're basically already down as much as the typical World War II bear market or post-World War II bear market. We could go down further, but we've already kind of gotten into that zone where bear markets bottom. The other thing I want to point out specifically about high yield bonds, and again, these are below investment grade bonds, they tend to decline during stock bear markets as opposed to treasuries, which go up, but they don't decline as much as stocks. And then when you look at the 12-month recovery numbers, you'll see that that light blue high yield bar recovers every bit as much as the stock market typically does when you come out of a recession. And this is a very interesting phenomenon with high yield. I mean, we've typically owned some high yield bonds in portfolios. We typically do not sell them in a recession. And we typically, like the last 2 recessions, we had very fortunate circumstances where we were able to buy high yield bond funds during the recession and had very good luck with that. And you can see why the returns 12 months after a bear market are comparable to the returns on the S&P 500. So that's kind of leading into this concept of what we're going to do with the portfolios going forward. So I wanted to point out that when you get into situations like this, it's very important to keep a long-term focus. And this is a chart I like because it shows various time periods and the return of the S&P 500 over those various holding periods. So you can see in the upper left, the 1-month holding period, you're going to have a positive return about 61% of the time. 1-year holding periods, you have a positive return about 77% of the time. 5 years, it's 91%. 10 years, it's 97%. And 15 years, it's 100%. Investments 101 will tell you that you shouldn't have any money in the stock market if you don't have a holding horizon of at least 1 year, probably even longer than that. So the probability of success of investing in stocks, and this is reason why the stock market has been probably, according to Warren Buffett, would be the best generator of wealth that you can choose, is because the market goes up the vast majority of the time if your horizon is long enough. If you look at the 10-year numbers, the only time since 1928 that you've had a 10-year return that was negative happened to be when you looked at the 10 years from the tech bubble, which happened to coincide with the trough during the financial crisis. Those are the only two years that you had any a negative return over 10 years. If you look at the 15-year time period, the minimum return historically over 15 years is a 4% annual return. So remember, a 10-year treasury today is giving you 0.6%, and there's a very high likelihood, historically speaking, that if you go out 10 or 15 years, you're going to earn quite a bit more than that. The other thing I wanted to talk about real quickly is gold. We have not historically owned a lot of gold, but we do own gold now in appropriate accounts, a small amount. And what I mean by appropriate accounts, we haven't been buying it for income-oriented accounts where they need the exposure to bonds and so forth. But for those that are appropriate, we do own some gold, and the reasons are in the current low interest rate environment, it tends to be a very favorable environment for gold. For example, this chart is showing you going back to the late 60s, when the 10-year treasury yield is less than the inflation rate, which it is today, what is called a negative real rate of interest, it tends to be a very, very favorable time for gold. Gold has advanced at about a 16% annual rate during that time, during those episodes. And even if you have a very flat real return between 0 and 3.5, it tends to advance at about an 8.7% rate. Now, there are other things that affect the returns of gold. This is not the only one. So gold has a reputation of being an inflation hedge. Its history as an inflation hedge is a little bit questionable. If inflation is high enough, it tends to be a very good inflation hedge. If it's just, you know, a run-of-the-mill 2 to 5% inflation, it's not quite as good. But inflation is something that tends to be favorable for gold. In this presentation, I really wasn't able to go into some of the details about some of the stimulus that's happened. I know that there are those on the call who the first thing they're going to ask me is about, you know, the deficit and where the debt levels are going. I just didn't have time to deal with that on this call. But with all that money going, that the government and the Fed is spending on these various programs, one can certainly make the case that there is potential inflation down the line. And that's another reason why we hold gold as kind of an inflation hedge or an insurance against surprise inflation going forward. So let's talk specifically about some of the current portfolio strategies, just to wrap things up. So as we all know, everybody has their own investment policy statement. Everybody has their own plan that's tailored to their objectives. In that plan, there is a benchmark equity rating and a range that we can go in around that benchmark weighting. We are currently marginally underweight equities versus that benchmark. And what I mean by marginal is we're maybe 2, 3, 4% underweight. It's not a lot, but we do feel that we need to respect that earlier slide that suggested that typically you're going to have some sort of a retest. It may be that we don't have a retest. It may be that that was the bottom and we're going up from here. But we are respecting history in that sense and maintaining a marginal underweight to equities. We are monitoring various signs that the stock market has indeed bottomed. I mentioned this in the call in March. It's really about looking for how broadly the advance is. Are we seeing a lot of stocks participating? Are we seeing small company stocks participating? Are we seeing a lot of new highs versus new lows? The kind of breadth that we'd like to see to suggest that it's a healthy advance. In portfolios, we are taking advantage of the fact that the market is down. We can sell certain things and realize a realized loss for tax purposes. This allows us to take gains to offset those losses as we're doing rebalancing in the portfolio without subjecting clients to tax ramifications. For those, and almost everybody has an investment policy statement that indicates some bond exposure. We do favor short-term investment grade bonds because we can get higher yields there than we can in the safer treasuries. We do still have some intermediate treasury exposure. We do like TIPS, which are inflation protected securities issued by the Treasury. Again, for inflation insurance, you can make the case, you know, if we see even 1 or 2% inflation going forward, TIPS are much better than a run-of-the-mill Treasury at any given maturity because of that inflation hedge that they provide. We do have some high yield exposure through mutual funds and ETFs. As I mentioned, we typically don't sell out of that. We might reduce it some in a recession, but we typically don't get rid of it all. We do own an ETF that has a very short-term bonds in it to limit the credit risk. And we're looking to add more through you know, our favorite high yield fund going forward. As I mentioned, we do have gold where appropriate for insurance against inflation and really just crisis insurance. Gold is often viewed as a alternative currency. It tends to be hoarded during periods of crisis. So that's kind of an insurance policy to go with the TIPS. And I want to emphasize that for those of you who are taking regular withdrawals from your portfolio, that we tend to keep between 1 and 2 years of your withdrawal needs in either money markets or short-term bonds, so that hypothetically anyway, you don't really have to sell any stocks during a down period like this in order to maintain your income. So that's really the summary of what we've been trying to do. We have been buying some individual stocks, just to take one quick step back, that we like, and we've been doing that when the market was down because we really are trying to operate on the premise that if we can look forward 10 years and if we look back and say, gee, we really bought that at a good price because it's a stock we liked at the time, knowing that we probably won't be able to ever buy it at the best price. But we do have a focus list of stocks, and we have been buying some of those in this environment, but we're still kind of maintaining that slight underweight. So with that said, I'm going to turn it back over to Brooke, and she can wrap things up.
Awesome. Well, thank you, Ken, so much for your presentation today. I think we can all agree it was great hearing your perspectives and insights, and I know everyone thoroughly enjoyed it. So thank you again, everyone, for joining us. We will be sending out a copy of Ken's presentation tomorrow, and we'll have recording available on our website as well. Hope you all have a great afternoon. Thanks again. Bye-bye.